Your Money. Joining me right now is Laffer Tengler, Investments Chief Investment Officer, and CEO Nancy Tengler, Bulltech Capital Markets Chief Strategist Catherine Rooney Vera, and Michael Lee, Strategy Founder Michael Lee. Great to see everybody this morning. Thank you so much for being here. Mike, kicking things off with you. Markets are rallying this morning. We've got the producer consumption expenditure out on coming up, and then we've got the GDP coming up on Thursday. What are your thoughts on this rally this morning after 8 straight weeks of declines for the Dow Industrials?
Yeah, Maria, I think we're getting close to what you can consider a bottom in terms of all this vicious selling. However, I don't see a massive rally back, and I think we're going to be stuck in a trading range for some time period. And while we are going to see this PCE number this week, the market is the equity market, I think, is somewhat looking past inflation and interest rates for now, given that the 10-year has gone from almost 320 back down to about a 270. So we're seeing some stabilization there. I don't think the concerns over inflation are as great as they were, say, a week ago or a couple of months ago. But what I think is the main problem for stocks going higher going forward is the balance sheet runoff, which very few people are discussing. So it starts at $45 billion next month, goes up to $90 billion in September. And I think that's going to put a huge overhang on the price of stocks as all that liquidity comes out of the market. If we remember, 2018 was the greatest year of earnings growth in history to date at that moment. And stocks were down that year 1 or 2%. So yes, if we get a blow-off number, the market expectation is for 0.2% growth on a month-over-month basis from the core number. If that comes in at 0.8 or 0.9 like it did last month, yes, that will send markets lower. I think that's pretty unlikely. I think we're starting to see some slowing on the month-over-month basis finally as the economy slowed dramatically, and I think the continued slowdown in the economy, the demand destruction, higher interest rates, lack of liquidity is starting to slow inflation down and is starting to slow down this price-wage spiral that we've been seeing for some time now. I, however, don't think stocks are going to explode much higher. I think we're going to see a trading range where we're going to see violent moves up and down 5 to 10% from the levels we're at now.
Yeah, Mike, because we don't know how this ends. I mean, you're talking about demand destruction and what has happened as a result of higher interest rates, Mike, but that's the point. That's the worry, that in fact the Federal Reserve is not going to be able to have a soft landing, that all of that pressure on rates to move up and pressure in terms of a tighter economy is going to cause a recession. Where are you on that?
Yes, so I think the soft landing is not a soft landing for the stock market. It's relatively strong employment and orderly markets. And so while markets have corrected, close to 20% in very quick fashion, it's not been huge gap downs, and there hasn't been major market malfunctions, and unemployment has stayed relatively high. So this is the version of the Fed's soft landing, which stinks for our stock portfolios, but in terms of employment and liquidity, or orderly markets, rather, this is their soft landing.
Catherine, you think about how the U.S.